Hello, welcome to for attending. My name is Siwing Yi from the Yi Real Estate Network. And today, on a weekly basis, I've been providing you a lot of real-time real estate information on nationwide housing markets, as well as specific market analysis in many cities and metros in recent past. All right, so the title for this Redfin update is Housing Market Update, Mortgage Rate Spike Further Cools Down Home Buying and Selling, published September the 8th last week by Redfin. So this article started by indicating that San Francisco saw home prices fall 7% year over year during the 4 weeks ending September 4th. Just so you know, physically, I personally live in San Francisco Bay Area for the past 33 years. So I understand about the cycles of specific markets here where we are in California, specifically the Bay Area. So anyway, and the article further mentioned that as a result of decreasing demand, fewer homes sold above list price than at any time since February of 2021 of last year. And also it says right here, the housing market always cools down during this time of the year, right, due to seasonality. But this year, I expect fall and winter to be especially frigid as sales dry up more than usual, the Redfin chief economist Daryl Fairweather said. And so due largely to a mortgage rate near at 6%, potential home buyers and sellers are focusing on back to school season and enjoying the last day of the summer. And also for the remainder of this year, the fourth quarter 2022, again, everybody kind of expect the sales transaction to be pretty moderate. Nothing, we're not going to see any kind of ramp up in any kind of home purchasing activities based on the current environment, especially with the interest rate. So, but for those homeowners that qualify to buy right now and they have a long-term perspective and they have, so there's nothing wrong for them to buy at even at this interest rate at 6% for homeowners, and for real estate investors, perhaps around 6 and 7, 6.5, 6.7% interest rate for real estate investors. But anyway, but most important thing is the very important down the road. Just remember that you can refinance when eventually rates do turn down. So that is a good positive reinforcement. The interest rate really can't go much higher than right now before it crashed the market. So we can only expect in the next few years the interest rate will go down. How much, we do not know. So there's a light at the end of the tunnel, in my opinion, with respect to the interest rate volatility. And furthermore, the leading indicators of home buying activity for the week ending September 8th, 30-year mortgage rates rose to 5.89%, their highest level since November 2008, which is at the height of the real estate housing recession, the great real estate crash of 2008. So yeah, it's a stark reminder. Some people are thinking back in those days, around 15 years ago, when we see the world's greatest real estate recession ever in history. So who knows what's going to happen beyond that. And then Redfin mentioned about the key housing market takeaway for 400 plus US metro areas. Again, this is a nation real estate market analysis by Redfin because every specific real estate market is very, very different. Real estate is local. So wherever you live or wherever you wish to buy investment properties, you have to refocus your energy on the specific market at hand, because again, the real estate market is very, very local, down to the neighborhood, down to the street, down to this specific city and specific, very, very specific. That's all I have to say. So although this national real estate analysis is a good overall, a high level indicator is, once again, you take this analysis with a grain of salt, right? It's like, it's all about trends and data, and just continue to get educated, get informed, and with respect to your own individual goals and objectives is a little bit different, right? So anyway, so I just want to throw this out there. And also the housing sales in San Francisco fell 7% year over year, the biggest decline since July of last year. And San Francisco and Oakland, the East Bay, fell 1.4%, which is the only year to date, right? We're talking year to date, September from 2021 to 2022. San Francisco and Oakland, the Bay Area, were the only two metro areas that saw year-over-year median sale price declines. That means 99.9% of the other real estate markets in the country has shown increase in housing prices, appreciation, and equity growth. All right. So just so you know, the monthly mortgage payment on a median asking price of a home is $2,337 at the current 5.89 mortgage rate, up 40% from 1664 a year earlier, when the mortgage rate were a amazing historical 2.88% interest rate. So this is we all know there has been a tremendous reset. It has been a shock and awed, if you will, quote unquote, shock and awed to a lot of home buyers and investors a few months ago. So we're going through a big reset, perhaps a slight correction, but a crash, I don't think it's going to happen based on the metrics and the data that I have researched continuously. All right, so this is just my opinion. And the rest of these words and paragraphs are pretty much supported by the following graphs, as I can go over from a high level, and then in a few minutes we should conclude, and I will give you my takeaway for what I think was based on this article, what my thoughts are. So this current graph, median sale price is up 6.2% year over year. So this means that, as you can see, 2020, or this gray line, the blue line is 2021, and the red line is 2022. As we can see, the big gap between 2020 and 2021, 2022, we have seen some epic appreciation at a historical benchmark, which we will probably never see in our lifetime. So because back in June, July of 2020, the median price of a nationwide homes were only $275K. Now, at the peak this past year, has went up to in the high 400s, and then since the interest rate drop and the price change, if you will, at this time, in September the 4th, the median price of a home is $269K, still a 6.2% equity increase year over year from 2021. So we still have some positive signals so far, but remains to be seen. All right, so median sales price has increased year over year, so there's a very good sign. We have not seen any steep decline yet based on this data. Who knows? All right, and then the next graph, which is median asking price plus 8.3%, which is very, very similar than a median sales price. So I'm not going to go over there. The next graph, which I would like you to direct your attention, is obviously since the interest rate spike in the past few months, clearly the home buyer mortgage payments were up by 40% year over year, right? So again, it's all about, for primary home buyers out there, it's all about the payment. It's all about monthly payment, because a year ago, right, the monthly payment is a lot less because our interest rate has been so low. Now, at projected 5.8% 30-year fixed rate mortgage, your payment has skyrocketed from 40% upward to around 2,300 per month. So that is a major concern. And then the result, what's going to be happening with the result? Here it is, pending sales. Pending sales, 19.1 decrease year over year in pending sales. This is a very important metric because, as you can see, 2021, the peak pending sales this year was back in May, June, right, which is up here. And then since May, June, July, August, September, the past 4 months, we have seen a tremendous decrease in pending sales. This means that the buyer demand has subsided drastically, and also the sellers perhaps are pulling their home off the market for whatever reason. And the main reason is that the sellers are most of the sellers who has a home, they are locked in at around 3% interest rate fixed year mortgage, so they have very little incentive to and motivation to sell, because for obvious reasons, right? So this trend is very, very interesting. 19% reduction in pending sales. So if we continue to see this trend decreasing, it'll determine the supply of inventory for sale. And who knows, right? If this trend continues downward for the next few months and beyond, in the early part of next year, we might see again some historical low inventory of homes available for sale, and that may create some interesting narrative down the road. So, all right, and then new listings of homes, also very important metric. New listings is determined by the home sellers, how many of them are willing to sell their homes, and that will create more inventory for buyers. So that could create a good healthy market. And the new listing of home is down 17.5% year over year, as you can see right here, a very steep decrease. So this is a very important downward trend. Back in just a couple of months ago in July, we have a pretty high increasing ever since the beginning of the year. Actually, we have more new listings until the interest rate has gone down drastically. Now we see a reversing trend right in the past couple of months, and whereby it's down 17.5% with 83,000 home new listings compared to 2021 the same time, which is at more than $100,000 listing, 2021 and 2020 similarly. So this is an important downward trend, and it just tells you that we are seeing low sales listings and low buyer demand. So these two scenarios are confronting and crashing against each other. So it's just number one is a very confusing market situation, something I've never seen in my 30 years of real estate consulting. So very interesting indeed. All right, so we're almost concluding. The rest of this graphic is not that telling. It's not that critical. Let me see what are some of the critical aspects of it. Active listings, no. I think that's pretty much concluding my analysis. Yeah, so here's my point. Here's my takeaway from this. My takeaway is again, because of the seasonality of the situation, and we're moving toward the last quarter of this year, we do not expect a big housing demand because everybody's just a lot of home people are just taking a break from this frenzy, if you will, that we have experienced the past few years. People have a lot of my takeaway is again is a lot of potential buyers are in a wait and see situation. They are staying on the sideline. They're monitoring what's going on with the economy, with the job market, with the recession pending something. And yeah, I mean, so at the same time, with the interest rate is around close to 6%, it's just home buyers are not willing to pull the trigger at this moment, even though a lot of them do qualify. I feel there's a lot of qualified buyers out there are just waiting to see some positive information coming out of the economy, and interest rate is a one big factor, right? So that's the and at the same time, sellers are pulling back. They are putting their homes, they are taking their home out of the market. So yeah, so we go through some very interesting dynamics, and my takeaway is if the trends continue like this, we could have less inventory of homes available for sale for the remainder of this year, maybe going to 2023, and then we, in case you have not heard, the builders, the new construction homes, the builders, nationwide builders they're trying to get rid of their existing inventory so they can clear their books for the year, for their fiscal year. And because of the lower demand, the builders nationwide are pulling back on constructing new homes. So the builders' confidence level is at a very low level. So you know how the builders works. The builders they build homes based on home buyer demand. Since home buyer demand has have a huge pullback, they're not constructing new homes to meet the potential demand of home buyers down the road. So again, we see if this trend continue, the inventory will be very low for the foreseeable future, even as low as we have seen during the past 24 months of the pandemic housing boom. If the interest rate is going to go down ever so slightly to maybe 1 percentage point or to 4.55%, then we may see some ramp up in activities, right? And with a very low historical low inventory, and with higher demand, with a lower interest rate down the road, we might see another mini boom for those reasons. All right, so that's all I have to say. And if you see a lot of value from this video, please click the like button and also subscribe to my channel. You will continue to receive weekly updates on relevant real estate information in real time, where I also provide investment real estate opportunities for people out there in the YouTube world. And all I have to do is, again, click the like button if you see a lot of value from this video, and subscribe to my channel. And also the third thing I would like to have is to subscribe to my website, so you will receive free real estate investment opportunity information into your email. You can become a free member of our real estate community, the Real Estate Network. Thank you for attending. This is Siwen Yi. Have a nice day. See you on next video coming up shortly. Thank you very much. Have a nice day. Bye-bye.